All right, welcome back to Accounting 2. We are moving on to Chapter 14, and we are looking at corporate worksheets. If you could go ahead and go to page 402 in your textbook. What we've done so far is we are Accounting 2. That means we are a merchandising business. It means we acquire raw material, we do something to that raw material, and then we sell whatever product we're making. We are also a corporation, which means we have some different equity accounts to deal with the owner's claim to the business. So we're going to back up just a little bit, and we're going to start up our companies. As we look at our objectives, we're going to define accounting terms related to distributing dividends and preparing a worksheet for a merchandising business. We're going to identify accounting concepts and practices related to distributing dividends and preparing a worksheet for a merchandising business. Journalize the declaration and payment of a dividend. We're going to begin a worksheet for a merchandising business. We're going to plan adjustments for a merchandising business for inventories and supplies, prepaid expenses, uncollectibles, depreciation. We're going to calculate federal income tax and plan worksheet adjustments, and then we're going to complete a worksheet for a merchandising business. It's going to be a lot more as far as account. It's not going to be a ton different, right? We're still going to deal with a column of trial balance, which is at the end of all the journalizing, right? Hoffman's doing his cash payments, Trent's doing the general, Jackson's doing the sales, somebody's doing the purchases, Clark's doing the cash receipts. We get all of those done, and they go to our person who I believe it was Ms. Keith. She's transferring it to this general ledger. Right. Now, in the QuickBooks world, you hit the enter button and it's done for you. But in the world that we're working in a little bit, it's still old school paper pencil, different people writing it down, one person just mad scrambling to keep up in that big 3-ring binder that has a running total of all of our accounts. Well, we take a break at the end of the year now. We probably don't do this monthly. And we open up that 3-ring binder and we just start writing out every single account that's got a balance. We then do our adjustment column, right? Stuff that got used up during the year. Well, we just have more of those. And now we also have to calculate federal income tax because corporations got to file their own tax return. We then do the balance sheet side, kind of the stuff that we have left, and then we do the income statement, which is our revenue compared to now cost of our raw materials and our expenses. Did we make money or did we not make money? So the worksheet's still the same, it's just more, okay? We have a boatload of key terms. Retained earnings, dividends, board of directors, declaring a dividend, this thing called merchandise inventory, uncollectible accounts, allowance method for recording losses on uncollectible accounts, this thing called book value of accounts receivables, current versus plant assets, depreciation expense, estimated salvage value, straight line depreciation, accumulated depreciation, and book value of plant assets. So we got a lot going on. This chapter will take a couple weeks. So let's start out and review Accounting 1. Accounting 1, we were a sole proprietorship. We had capital and drawing as our owner's equity accounts. We were also a service-based business, so we had revenue and expenses, and that was all we had. Life was pretty simple. In Accounting 2, we're now a corporation, so we have similar accounts, just not the same. We have capital stock and retained earnings. That replaces capital. We have dividends that replace drawing. We still have sales, right? But now we also have purchases and any kind of returns, whether it be sales or purchase returns, and we got merchandise inventory. Okay, we still have expenses. So we just have a few more pieces to the puzzle to figure out whether we made money or didn't make money. In starting up a corporation, you're going to have to write up a business plan, and you're going to have to figure out how much money you think you need. Now, if we were sole proprietors or if we were partners, we would either go to the bank and borrow that money, or we would save that money out of our own pocket. At a corporate level, you probably need more money than you're going to get from your local bank, or you're going to save up yourself. I'm not saying it's impossible, it's just not likely. So what you are going to do is you are going to incorporate. So you're going to go to the state that you are going to incorporate your business, and you're going to have some paperwork to fill out. But you're also going to have to determine through your business plan, how much money do I need? Okay, what am I trying to do with it? Am I building a factory? Do I need inventory? Whatever, right? So Clem is going to start up Clem Corp. I think I need $500,000 to make that happen. Startup cash, because again, I'm not going to open my doors immediately day one and have revenue coming in. So I'm going to need some cash to pay for things like hiring my workers, right? And buying the inventory and purchasing equipment and buying or building or renting a factory, right? Or whatever it is I need, okay? And even once I'm up and running, I'm going to need a little bit of cash to kind of keep me going, because again, I cannot stress this enough. Companies spend money first. They then hope to recoup some of that money that was spent when they open their doors in the form of revenue. Okay. How does a company lose money? Well, they spend this much money, but they only collect this much coming back in revenue. So Clem is going to work with the state of Minnesota to start up this new corporation. As that's where we're based. I've decided that I think I need $500,000 to make that happen. So I need to now calculate my shares, right? The number of shares that I want to issue times what's called the par value, or the stock price, has to equal $500,000 in my example. I could issue 500,000 shares at $1 a share. I could issue 250,000 shares, but they're $2 a share. I could issue 5,000 shares and sell each little piece of paper for $100 per share, or any combination in between, right? I'm going to the state to figure out, hey, I need this much money. They need to approve that. And again, we're way overly simplifying this, but I then say, all right, if I want to sell these shares of stock, what do I think I need, right? What is the price that I can charge? Maybe I want to charge $50 a piece, right? And at $500,000, I'm selling them at $50 a piece. I need 10,000 shares. And then the hope is once I go and figure that out, somebody will want to buy that and invest in my company. And I may be one of them, right? I may be running the company, and I may have money on my own, but I'm going to buy some of those shares as well. When I do that, I'm going to go work with a company, an investment bank, like a Goldman Sachs or a Deutsche Bank, and they're the group that's actually going to go to the stock market and get people to buy my shares of stock. And that's called an initial public offering. Clem doesn't drive out or fly out to New York. Clem doesn't open up an Ameritrade account and say, hey, I want to sell stock in a new company. Somebody else has to look at that, approve that, just from a fraud standpoint, from a legality standpoint. So you're going to need to work with one of these investment banks. And now I got cash to run, and now I'm good to go. So as we tie into what we're going to start with here, back in the day, or in accounting one, if we made more money than we spent, which was revenue bigger than expenses, that additional profit would end up in the capital account. Right? That was kind of chapter 4, 5, no, that was chapter 6, worksheet, chapter 7, financial statements, and then chapter 8, we do the actual journalizing of the adjusting, journalizing of the closing. We'd actually get the money from income summary into the capital account. Capital account would go up if we made money, right? We could use those profits to pay ourselves, the owner, in the form of drawing, or we could use it to expand the business. We're doing the same thing, we're just doing it a little different way, right? If we make money in accounting 2, meaning our revenue is bigger than the cost of merchandise, the raw material that goes into our product, and our expenses, it will need to go to somewhere, but we don't have a capital account in accounting 2. Our profits are going to go into this account called retained earnings. Right? If I go sell my shares of stock for $500,000, 10,000 shares at $50 a piece, that's a historical transaction. That's done and gone. Right? I don't or can't say, hey, I made money this year. Now I'm going to go back and change that capital stock and price I issued to that. That just doesn't work. Okay. I need some other account to kind of hold on to either my profit or lack of making profit. That's going to be called retained earnings. Okay. Or we can keep the cash in the business and make us bigger, faster, stronger. If we don't want to do that, we could give some of it back to the owners, but it's in the form of dividends. Right? Dividends would be essentially the same thing as a drawing account back in accounting 1. Okay. So we're going to hit pause here. This is more kind of background information for accounting 2 type ideas. We'll get into the nuts and bolts of declaring dividends and filling out worksheets and all that next. All right.